Okay, unless you've been living under a rock for the past couple of months, then you are familiar with everything in the news about Doge and spending cuts and about Democrats versus Republicans, and they're cutting these jobs and they're cutting these programs, and a lot of political stuff going on there. So, my purpose here is to try to explain to someone who doesn't work in the financial world what I believe is going on. So, first things first, I decided after hearing all this in the news to dig into the actual financial statements of the United States federal government for the purpose of determining, just from looking at the numbers, what our issues are. So, I'm going to jump right in. All of this information came from websites and publicly available data such as fiscaldata.treasury.gov, mostly from the Treasury websites and from their data sets that they provide on a regular basis. And as I go through, I'll show these. I'm going to try to make this as quick a video as possible to just put it in a format where anyone listening could understand. So, first and foremost, spending. So, where does our money go? If you look at this chart right here, this is our spending from 1974 all the way until 2024. Starting in 2001 is where I was able to find data sets I could easily get to that break the spending out by category. So I'm going to go through real quick. So this bottom tranche here is Health and Human Services. This is Medicare, Medicaid. The second tranche is Social Security Administration. Third one is Department of Defense. This fourth one here is Department of Veteran Affairs. And everything above that are other departments. You can see here there's just things like Department of Transportation, Department of Education, all those things. But you can see they don't really compare. The bulk of our spending is in Medicare, Medicaid, Social Security, Department of Defense, and Veterans Affairs. Okay, so now I'm going to show you where does that money come from. So we generate all of our income, for the most part, from taxes, corporate and individual taxes. This is our total income in those exact same years. Again, this information from those same data sets. You can see that it's kind of tracked up until about 2000. We started spending a whole lot more than we brought in. 2009, 10, 11, spending a whole lot. And then obviously getting into 2020. Well, you can see in the last 4 to 6 years, the gap has grown astronomically. So how do we fund this? Well, we have to take on new debt. That's an important thing to consider, new debt. So this is the total debt we've taken on in each of those years on top of the tax income in order to pay our expenses. Now, in some years, like 2020, we took out a whole bunch more debt than we needed for our expenses. And this, again, is new debt on top of what we already have. So, okay, I'm going to shift gears from there. One thing I want to show too, a lot of people look at this in terms of percentage of GDP, or total gross domestic product, which is how much, products, services, and everything as a country we sell in a given year. This is that green line there is GDP, and this is relative to that. So, but I'm going to take this off of there just so we can look at that in a little more detail. So, okay, now I'm going to shift gears. Now, our total debt. How much is our total debt? 2024 is about $35 trillion with a T. Trillion. $35 trillion. That's insane. Now, that is broken down into two categories: marketable securities and non-marketable securities. Marketable securities are treasury bills, treasury notes, treasury bonds. This is issued to the public, so it can be traded, bought, sold, so on and so forth. Non-marketable securities are securities that aren't traded anymore in an open market. They're actual, what we borrow from Social Security and Medicare, all those things. So I'm going to get into marketable securities first. This is an important distinction. T-bills, treasury bills, are due when they're issued. They will come due within 12 months. Notes, those come due within 2 to 10 years. Bonds come due greater than 10 years. So that's the distinction between the three types there. There are two newer types of securities which scare the crap out of me. In 1997, they introduced Treasury inflation protected securities. This means that as inflation goes up, the principal on those securities also goes up. So it's a moving target. And then the scariest one, in 2014, they started floating rate Treasury securities. It's basically an adjustable rate mortgage, what caused the 2008 housing crash that our government has started issuing in order to raise more funds. So this is the breakdown here. You can see in 2024, majority of everything is in bonds or in notes, which is 2 to 10 years. We have the orange here is going to be your bonds, which are greater than 10 years. And the bills. I want you to notice the growth here. It's growing proportionally, the number of bills being issued compared to bonds and notes. So people are wanting to get their money faster. Okay, now moving to non-marketable securities. So marketable securities make up about 27 trillion of that debt. Non-marketable about 7 trillion of our debt. Now this is intergovernment basically. So you can see this blue section right here. This is called GAS accounts, government account series securities. This is what we have borrowed. That blue section is what we have borrowed from 2.5 trillion from Social Security, 1.8 trillion from Department of Defense, retirement, 1 trillion from civil service retirement. Now, I want to make a point here. Social Security, we've borrowed 2.5 trillion from them. This is as of as of February of this year. The total assets for Social Security as of 9/30/24 is 2.9 trillion. So everything Social Security has been given to the federal government in exchange for debt and interest payments. Same with the civil service. So these entire funds here, Social Security, Department of Defense, and Civil Service are all given to the government as a matter of policy. They're required. Every dollar that comes in immediately goes into Treasury securities. And then those interest payments, we'll get into interest here in just a second. But I just wanted to show the distinction. So marketable securities are bills, bonds, notes issued to the public. They're traded on open markets. Non-marketable are what we take from Social Security, retirement funds for the government, all those types of things. So, okay. Now I'm going to get into interest payments. The consequence of all that debt is interest, okay? Bills that are due within 12 months are the highest interest. I think it's like 5.2% right now on bills. And then the bonds and notes have lower, around 2%, somewhere in that range of interest. So the longer the term, obviously less interest payments. Now, one of the things I want to make a distinction of, if I give you $1,000 Treasury bill and it has a 3% coupon rate, note and has a 3% coupon rate, I'm going to pay you 3% interest on that $1,000 from now until it's due. But those are traded, so you may only buy that for $950. So you're not only going to make the 3% interest, you're also going to make $50 additional when I pay you the $1,000, and you only paid me $950. So I want to make that distinction because this is our interest that we paid from 2012 to now. You notice, and it starts creeping up. This blue section at the bottom here is the actual interest payment, that coupon. This orange section is called amortized discount. This means this is the amount that we've recognized. Okay, we have to pay. You bought it for $950. I'm going to pay you back $1,000. This is that extra $50 I had to pay you on top of the interest. Look at the growth there. That means that yields are getting higher, which means people are wanting to pay less for the actual debt that we're issuing. So that is a concern there. Yields are going up. And that's an expense. This blue section is the interest on GAS, the non-marketable securities, Social Security, Department of Defense retirement, all that. So these interest payments too. It's very interesting though, when you look at our financial statements, the interest here and here is recognized as expense. But because this is actually a transfer from one government account to the other government account, it's on there, but it's not recognized as an expense. So I'm going to jump back up here real quick and show you, if I add interest into these expenses here, this is what that looks like. These bottom, this red and orange, are those two expense accounts. The orange is for the government transfers for GAS, for the government account series securities. So you can see this interest is starting to rise, and that's going to be an issue as we go forward. It really is eating into our ability, and it's going to continue to rise. Now, the other side of this coin is, okay, well, we have 35 trillion and it's all due at different times. Some are due this month, some are due 12 years from now. What does that look like? When is this debt coming due? Okay. This top chart is a daily chart of debt coming due. These numbers are in billions. Or I'm sorry, in millions. So this here is 200 billion. This is 250 billion. And this is daily what comes due. So not only do we have to issue new debt to make our expenses, we also have to issue debt to get money to pay off our existing debt when it comes due. So we're constantly taking debt to pay off debt and then taking more debt to pay expenses, which is a huge issue. In 2025, we have $9.5 trillion coming due that has to be paid. That means the T-bills that we issued last year that are coming due this year, plus notes we issued in the last 10 years that are coming due this year, plus bonds we may have issued 30 years ago that are coming due this year. We have $9.5 trillion. So we have to issue new debt on top of what we need for expenses just to pay off this debt so that we can continue this game, continue the kick the can down the road. And we issue that debt out into future years. So I think this is one of the main drivers when we talk about Doge and spending and all that kind of stuff. That is the issue. Now, this chart here shows the same information, the spending and all that, but it's as a percentage of GDP. I want to make that clear. So you see these are flat lines because it's as a percentage of GDP. When you look at my expense, this is in dollars. So, you know, GDP is rising with these as well. Our gross domestic product is rising as well. But this one is in as a percentage of GDP. So I want to make that distinction. But look here. This dotted line is this year. Here's where we are. You can see from the dotted line, the dashed line here to the blue line, that's our interest expense. This is in the past. This is going forward. Look at the interest expense, how quickly it is projected to rise as we continue our addiction to debt. Okay, it is not sustainable. There's an entire section that's been in our financial statements from the federal government titled An Unsustainable Fiscal Path or something like that. But it literally is a section in every statement for the last 12 to 15 years that says, hey, we can't keep doing this. Like, this is a problem. You know, it's not a Republican problem, a Democrat problem. They want to argue over what we're spending on. It doesn't matter. What's the solution to this? The only solution to this problem is right here. These expenses have to come down. I don't know what, everybody's arguing over where it should come from. It has to come down. We can't keep look at the last 5 years and the amount of debt we have taken each year. We cannot continue to do that. At the same token, these green bars, tax income or whatever income, have to go up. So we either have to bring in more tax revenue or find other sources of income, maybe tariffs. I don't know if that's what but they have to find more income. It's going to have to be both. It's going to have to be income going up and expenses coming down. Just like a business is losing money every year and the bank says, hey, you're too risky. We're not loaning you any more money. That's where we are at. So the business has to do what? Figure out a way to bring in more money, cut some of their labor force, cut some of their expenses, find cheaper insurance, whatever they have to do to bring expenses down, and then find new customers or new products they can sell to be able to bring it up, to get rid of that imbalance. That's where we're at as a country. So I hope this is helpful to see and just think through. I spent a lot of time digging through this information, a lot of stuff that I didn't really see, but as you listen to them argue on the news, I just want someone who may not look at this kind of data on a regular basis to be able to look and say, those are all political. They're trying to, argue for votes right there. They all know this has got to change. It has got to change, or else. Now, the last thing I want to say, let's say that it doesn't change and they get into a big political argument and they don't raise the debt ceiling, which a lot of people are a proponent for, and we miss a payment. Guess what happens? All of a sudden, we can't issue any more debt because our credit rating has dropped and no one wants to buy. Or they're going to buy our $1,000 bond with a 3% interest for $600. And guess what? These expenses here on interest are going to shoot through the roof. And what's that going to cut into? What if our interest was up here at this halfway point? How much expenses? We would run out of money. We'd be insolvent. We would not be able to issue debt to pay off our old debt and also to pay expenses. That would put us in a situation where this funding would disappear overnight, in my opinion. So, anyways, all that to say, hope this is helpful. Hope you got something out of this. My goal was try to explain this in less than 10 minutes. I'm at 16 minutes now. But again, I'm not a professional. I'm not a CPA. I work in the business world as a consultant, but I just felt like looking at this in maybe some pictures and some images would be helpful. It's helpful for me. Hope it was helpful for y'all as well. Yeah. Hope y'all have a good day. Hope we can get this figured out.